welcome to Business Television India. You're watching Market Guru with me Piyush Jain. Joining us today on the show is S. Krishna Kumar, Chief Investment Officer at Sundaram Mutual Fund. Mr. Kumar, welcome to the show. And let's start our conversation with the new NFO again, the new fund NFO again, which you're bringing to the market. Help us understand what it is again, what you're targeting, what basically investors again would be getting from this fund.
Yeah, we are launching the Sundaram Equity Fund, our potential flagship multi-cap offering to the markets. The mutual fund industry has seen a lot of progress over the last many decades, and the multi-cap segment of the mutual fund industry has become a very important part given the investors' asset allocation plans wherein a lot of investors benefit from being invested in the multi-cap segment. Our multi-cap fund is having the flexibility to invest across the large cap, mid cap and the small cap space, and this provides an ability for the funders to optimize investor returns, optimize the returns vis-a-vis the limited volatility that the product will bring in. So the focus is on providing the customer with a unique low volatility, steady return kind of experience over the medium to long term. So we intend to have this fund invest about 65 to 70% in the large cap space and about 20% in the mid cap space and about 5 to 10% in the small cap space. This would be the kind of allocation that we have to start with given the current environment and the market conditions. Over the course of the year and the fund's tenure, we would tend to flexibly move the large cap allocations up or down depending upon the economic growth, the utilization levels in the industry, the credit growth and also relative valuations across different categories of market cap stocks.
Okay, so that's interesting. And now let's build around the conversation again around how again the strategy and the market is looking to you. Now, given the fund again, new NFO again is coming up, but the question now is about fund priority, capital allocation. So from that perspective, how's the market looking to you? Is it a market where you would like to actually go overweight on debt, perhaps again to your suitable limits as you were just talking about, or you think it's a good time to really again nibble into stocks which are available at good valuations?
I think one of the trends that we track is the gap between the 10-year GSEC yield, which is a risk-free rate, and the earnings yield of the Nifty or a mid-cap index to assess the the yield differentials given the risks that are there in the different investments. So at this point in time, the earnings yield gap is just about 0.5% between the 10-year GSEC and the Nifty, whereas it is about minus 1.5% in favor of the mid-cap index at this point in time. So clearly we do believe that the equity is offering a good return perspective at this point in time, and particularly as you go down the cap curve, I think the outlook from a 3-year perspective looks good. Historically, we have found that whenever the yield gap turns negative or moves towards a 0 point, over the next 3 years post that, we have seen a lot of instances where there is a high probability of positive return of 50 to 60% over a 3-year time frame. So I think at this point in time, given where the valuations are at 12-13 times 1 year forward on mid and small caps and equities at large using the Nifty index at about 16 times 1 year forward, we are very comfortable recommending equity investments to investors, and that too particularly a multi-cap product as a core part of equity allocation, and then you can build on with the mid and small cap exposure if the risk profile is high, or use a large cap fund to tweak it if the risk appetite is lower. So I think that forms the core philosophy between for a multi-cap fund at this point in time.
Sure, and let me try and read into your mind from the perspective of mid-cap versus the large caps. traditionally we know again from the margin of safety point of view or a risk point of view or a growth point of view, but right now at this point of time when the bank credit growth is not picking up, perhaps there are growth concerns but the valuations again basically are also reflecting that again from a mid cap or small cap point of view, where you actually will like to actually be invest more is on the large cap side or mid cap side, not from the amount of point of view, because obviously like in large caps you will have higher weightage, but from a tactical point of view where perhaps the choice is going to be.
I think from the perspective of the Sundaram Equity Fund, we are quite conscious of the current environment in terms of sentiment being quite low. We do believe that valuation comfort is there if you take a 2-3 year perspective. So we would balance the expectations in terms of investors, in terms of returns, in terms of volatility, and also the availability of sectors and stocks at right prices. So we intend to go with a 65 to 70% large cap bias, and the rest of 30% would be spread across mid and small caps. So even within the large caps, basically one has the flexibility to be across the cap curve from 30,000 crores to 8 lakh crores, right? So I think if you need to show your belief in terms of valuation comfort, you can also build in a set of portfolio of high growth large caps which are in the range between 30,000 crores to 2 lakh crores also, thereby bringing your average weighted market cap to levels that are comfortable.
Okay, so that basically is the sort of premise again is what is being heard. But Mr. Kumar, let's now talk about the sectors. Now we have seen the June quarter earnings, and before I ask about the sectors, from the June quarter earnings, what are the conclusions? What are the sort of insights you are drawing for FY20 so far?
I think we had a lot of negative news coming through this quarter in terms of auto sales being down 10 to 25%. We also saw the housing sector not really doing well. We also had some amount of softness in consumer FMCG demand. So we went into the quarter knowing fully well that the expectations have to be toned down, and in line with that, I think we've had a growth of about 7% on the Nifty and an 8% number on BSE 100 companies in terms of reported earnings so far as of last weekend. This compares with a 15-16% earnings growth outlook for the full year and the next year. So we do have a bit of catch up to do in the rest of the year if you have to meet the numbers that we are talking about. The good thing is that large bulky recoveries that the banking sector is expecting in terms of Essar Steel, Alok Industries, Bush and Power, etc. are still not in. So chunky numbers in terms of profits would flow in the quarter when these assets get into a recovery mode. So we do believe that there is a lot of runway ahead to be able to meet the 15-16% Nifty growth number for the year, and we are confident that the second half of the year would have a lot more growth to drive home than the first half has been, and into the next year we do expect a good recovery across which is going to be more broad-based in the economy.
Right, again, so from that perspective, the second half is looking better, Mr. Kumar. Which sectors you think again could be driving that sort of growth outlook?
I think you talked about the financials. I think credit growth is something that we expect to accelerate in the rest of the year from the paltry high single digit or low double digits. We do expect the credit growth to pick up to over 15% by the end of the year. So we do see a lot of growth that could come on the banking sector. The second big area in terms of insurance, in terms of wealth management, I think is again a very secular growth story. We believe that that's a good space to be in for the long term. More from a cyclical perspective, which is where our bets are at this point in time. We believe the consumer cyclicals, the discretionary products, be it white goods, brown goods, kitchen appliances, home improvement solutions, retail, are definitely going to see a good uptick into the next 6 months. supported by better financing, etc. We also believe that the capital goods and the cement space, which are benefiting from the government-led capex, I think we do believe that those could see some good earnings uptick at this point in time, given the low base that they have.
Okay, and that's interesting. What's the view around the sort of recent slowdown, the asset quality in the financials? Also, again, the slowdown which is apparent in consumer discretionary. Is this something which you think is temporary and can get corrected over the next 1 or 2 quarters?
I think definitely it's a bit of a cyclical slowdown across autos, etc. Consumer durables, I'm not too sure whether it's a big slowdown, because still growth rates are double digits in many instances, like air conditioners, washing machines, painting solutions, etc. So I think if you look at the retail companies, again, that had good growth. Jewelry, accessories have been pretty good. High single digit and double digit growths that have come through. So I think we expect to see an improvement in terms of growth trends going forward. Definitely, we do believe that some of the measures taken by the government to help infuse more capital into the PSU banks to onward lend, and the RBI, which has made a lot of efforts in policy making to bring in more liquidity, dropping rates, and ensuring transmission. Also, in terms of measures like allowing higher lending for particular NBFCs based on the tier 1 capital, also reducing risk weights on consumer loans to 100%, also upgrading the limits for housing loans, rural loans, and MSME loans to qualify for private sector lending. I think these are measures taken which bring in a lot of confidence that things will start to look up in the next 3 months.
Weeknights at 8 p.m. only on Business Television India. म्यूचुअल फंड सही है, मगर क्या सही है और क्या सही नहीं है? जवाब के लिए देखिए The MF Guide Show, weekdays at 12:30 p.m. only on Business Television India.
What's your view again, what's happening in the global markets? Now Argentina perhaps could be one example. Indonesia again, we are seeing a bit of volatility. On a global backdrop, where again I'm seeing again sort of declining yields in the European markets, US yields again, those have been declining, gold prices going up. So from a holistic global perspective, how's it looking to you?
The developed economies are definitely slowing down. After a huge long extended phase of growth, you're seeing US get down to 2%, Eurozone getting to closer to 1%, and so we do believe that this is forcing the central bankers there to become more accommodative, to abandon hawkish policies and being more softer on rates. So with this and the lower inflation template that we have, we don't expect hard currencies to outperform. So with the comfort of softening rates globally, the emerging market central bankers have a lot more space to unleash ammunition to stimulate the economy monetarily by providing more liquidity, by reducing interest rates. So these are things that we have seen happening the last 1 year, and we do believe that there is a lot of growth happening out here, which is quite interesting for investors globally. So there is a lot of shifts that we expect for money to flow into emerging markets in a big way, and particularly like a country like India with good political stability and a reformist government, we do believe that we will be major beneficiaries of good portfolio flows. The only hassle is that some of the measures from the government have not been taken well by the FIIs in terms of surcharge on taxation for trusts, etc. So we do see some resolution there with the government stepping in, and once these things do fall in place, I think we would see again FIIs becoming quite interested in the markets in India given the growth outlook here.
Okay, so that's something which should be very interesting. Also, let me ask, I am tempted to ask you again the recent sort of fund flows data over the last couple of months. What's your insight into that? Again, we actually have seen SIPs remaining very robust. Also, again, we actually have been seeing again the inflows again have been again relatively been very stable. So how's the sort of domestic confidence, the sentiment looking to you?
I think this is a very nice behavioral change that we are seeing, where people are committing SIPs with a good long-term perspective in mind, with a reasonably sound asset allocation plan that they have worked out along with their wealth advisors basically. So we remain positive, that if SIP flows from domestic investors will pick up, given the yield gap narrowing between the G-Secs and the Nifty earnings basically. So I think this basically is a precursor to returns getting a lot more positive from where we are at this point in time. So we remain quite confident that the educated investor is benefiting from being patient with his disciplined style of investing.
Right, and Mr. Kumar, now let me ask you a question, I think which our viewers will like to listen with great interest, with again keen interest. And again, which are those themes, even again sub-themes, if you want to talk about any sub-sectors also, where you are actually either turning overweight or you're already overweight, or again now you think perhaps it's time again to really increase the weightage?
Yeah, I think as I mentioned to you, the investment cycle plays domestically are a good place to bet on. Last 4 quarters we have seen order flows, order momentum increasing for the industrials and capital goods companies.